no plan survives first contact. You keep your original version, but you update versions as you go over time. Underwriting is really at its core, it's risk mitigation. It's vetting your property, it's income, expenses.
Greetings, well builders. Welcome to Get Diversified, your go-to podcast for all things real estate investments.
I'm Jacqueline.
Melvin Landry. We're thrilled to embark on this wealth building journey with you.
Imagine this. What if your investments not only secure your future, but also unlock a life of financial freedom? That's what we're diving into on this show. Apartment buildings, storage facilities, mobile home parks, the whole shebang.
But here's the kicker. It's not just about investing. It's about crafting a legacy, building memories with your loved ones, and seizing every moment. Time is the currency of life. And let's be real, none of us wants to waste.
We've got the insights, experience, and dash of excitement to spice up your investing game. Plus, we'll throw in some real-life stories that'll make you see the potential in every brick and mortar.
Subscribe, buckle up, and get ready to turn your investments into the ticket to financial freedom. Together, we're not just building wealth, we're building the community of savvy investors. Let's get diversified. Hello, folks, and welcome to another episode of Get Diversified. I'm your host, Melvin Landry, and look, today, folks, we got a fantastic guest. Got a guest of mine here who we're in the same rooms. We talk the same language, and this is this big guy here, Mr. Tom, who serves our country. So, Tom, thank you for your service. And I want to be first here to introduce you, Mr. Tom Rivenbark. How you doing today, sir?
I am doing wonderful. Thank you for having me on, man.
Okay, good. Well, folks, look, let me tell you something. Tom is an analytical mind wizard. His claim to fame is underwriting. Does underwriting.
That's my jam, man.
That's his jam. And he's in a bunch of deals. He's in a bunch of opportunities, and he's contributing to the groups that we're in. So, Tom, won't you share for the listeners? Tell us a little bit about you. Kind of, you want to go back as far as you want to. Talk about, your service, things of that nature, and how you got into real estate, man, and how you thriving today, man. So go ahead. You got the floor, buddy.
So, did about 26 and a half years in the Army, a little over 20 of that on active duty. I had some guard time as well. Most of the time I was in the military. I was working at higher level headquarters, 2-star, 3-star general level headquarters. Ended my career at the Department of the Army for headquarters, Department of the Army. Doing analysis, either money or people or capabilities. And that kind of developed my analytical mindset because you really have to kind of tighten up what it is you're doing when you're briefing at that level. It also, because of that time in the military and being in units, kind of built this this thing in me where I have a ability to close deals, whether it's getting the mission done, closing deals. In the Army, we say improvise, adapt, and overcome, because no plan survives first contact. So you got to realize that when you're making a plan, you got to have, it's what we call branches and sequels. What are things that can lead into your plan that can change it? And what are ways to get out of your current plan that you might have to veer left, veer right? You got to think about those things. And those tie in real nicely with underwriting, because you always want to stress test your stuff. You want to think about what are the possibilities, what could come in that could change my plan, or what down the road might alter my plan. So that all kind of fits in there. So I retired back in 2019, met my current wife at yoga.
Okay.
She was, she had a little side business making pickles and doing stuff at a farmer's market. She needed help, and I had some free time. So I met her, and, a few years later, we ended up getting married. She'd been doing real estate since about early 2000s. She did a couple flips on some houses. She got a little more serious about it around 2008, had some single families, was managing them herself. That's another way I kind of met up with her also, is she needed somebody to kind of do some handyman stuff. And I had some downtime because I was retiring, had a bunch of terminal leave.
Okay.
Then after we got married, we, continued to do that. We had up to like 13 doors at one point that we were self-managing. And, while the cash is good, it's a lot of work to self-manage single family, especially when you both have W-2 jobs. So we decided we needed to scale. So we've gotten rid of, we still have 8 8 or 9 doors that we manage. One that's completely out of the state that somebody else manages, but the rest we still self-manage. And we started to scale up into single family homes. We joined a mastermind, kind of learned the 101s about here's how, the different aspects of the deal. It started networking, got into some other groups where we've just kind of expanded our networking sphere and have met some great people, have learned a lot of things, and have gotten into some great deals. One of the groups we got into more recently, the core, has been pretty beneficial to us. We got into several. One of the things that I liked about that was that it wasn't just focused on single family. We started out just in single family, but now we've diversified through the core. We've gotten into some RV parks and some self-storage. And I got to tell you, I like both of those a lot. There's some money to be made there. There's some good investments. So that's kind of where we're at now. We've done some limited partnership. We're in some joint ventures. We're in a joint venture in Anchorage that we closed on towards the end of last year. Just closed a JV on an RV park 3 weeks ago.
Yep.
And then we've KP'd on some stuff. So that's kind of where we see the next kind of iteration of our journey going, is getting more into that KP and the JV and GP side. My wife is real big on capital raising. So we're leveraging that. And as we talked about, my jam is underwriting. I like to find deals, do underwriting on. I probably underwrite 10 or 12 a week, in addition to having my regular W-2 job.
Mm-hmm.
I underwrite for other people as well. And then asset management is something that I excel at as well. That's just part of that kind of culture that was built into me of figuring out problems and developing solutions for them from being in the Army for so many years. Okay. So that kind of leads us to where we are today. And just want to grow bigger, better. That's all.
Amen. Amen. Good, man. Let's jump into the jam a little bit, man. So you talk about
all right.
Underwriting, right? So we know, hey, you're the guru in terms of underwriting, particularly within our group setting. We're both members of the core. We'll send a shout out to the team there. And let's talk about your approaches to underwriting now versus, say, 6 months ago. Were there some different intricacies? And the reason why I'm asking the question, you say, man, every time I write a deal, I learn something different. I learn something new that I didn't know before. So why don't you share some of those insights on what are some learnings that you kind of got out of it as you progressed in the underwriting journey leading up to today for the listeners?
Yeah. Well, I mean, I started really just underwriting multifamily homes. There's different classes of commercial real estate, and underwriting each one of them has its own little intricacies. So you really kind of need to understand that class of real estate. I started out with, like I said, the multifamily, did some work on self-storage, and now I'm kind of working my way into RV parks. Every time, whether it's, moving one class to another, just underwriting another deal, there's usually something that I figure out in underwriting that deal as I dig deeper into it. It's like, I haven't thought about that before. And it just helps to kind of build on that knowledge base that I think is so important for underwriting. Underwriting is really at its core, it's risk mitigation. It's vetting your property, it's income, expenses. You want to figure out if it's going to be profitable. And really at its core, underwriting, it's just simple math. That's all it is. It's not difficult, but what makes a good underwriter is somebody who has done a lot of it, has an analytical mindset, and kind of understands the finer points of it. What does right look right? What does right look like, and what does wrong look like? Because if you don't understand those things, you're just kind of treading water. Underwriting is the foundation for really any real estate deal. And when you're doing that underwriting, you need to be thinking about the business plan that you're going to try to put in place with this, because those two things work together. One doesn't lead to the other in my mind. The two work in concert, because you want to figure out what's the best and most optimal scenario for this particular situation. And then even the underwriting, it's a live thing to me. It will continue after the deal closes because you want to use it as a check on both on where you are in relation to where you thought you would be with your underwriting. Yep. And you also want to use it as a tool to project maybe where are you going from here. Remember that branches and sequels thing. You use it and you keep it live and you keep updating it. You keep your original version, but you update versions as you go over time. And that helps you to give, number one, it gives good solid underwriting. Showing that you do that also helps when you're going and talking to some of your investors and stuff. You can kind of show them over time how your underwriting has progressed. If they're more interested in maybe digging a little bit deeper into the weeds and stuff. So, I mean, that's kind of how I look at underwriting. There's a lot of things you got to think about when you're underwriting. With your expenses, first of all, insurance, taxes. You want to think about the population that's in the area that you're at. Is the population going up? Is it going down? If I'm investing in an area, I want it to be an area where the population's showing growth over the last 3 decades. Because if the population's going down, you're losing people to put into your places. You also got to look at income. Can the income, and not just in the whole city, don't just Google, Chicago average income, because that's not going to get you what you need. You need to look down almost to the city block of where it is you're looking at going into. Figure out what kind of income do the people there have, because you get these little pockets of people. And if you're in the wrong little pocket, it maybe can't support the rent that you think you need to get. Tied to that, thinking about your economic drivers. What drives the economy, not just in that general area, but in that little community? Are there enough things there that are going to keep the economy growing? Big industries, great. Schools are great, like universities. You want to think about what are the rent trends there? How is rent going up on average? How much is it going up? And not just right at this minute, what's it doing? What's it done in the last 3 years or so? Because with COVID, there were a lot of areas where rents just spiked. I'll use Austin, Texas as a prime example of that. The rates there just took off. So people were like, oh, that's great. We're going to bank on this. But now the problem is, they rose a little bit too quick. So now they're actually, rents are going down a little bit. So you have to think about that. You need to look at what are the rents over time. You want to look at what are the vacancy rates in those areas and understand why are the vacancy rates the way they are. Is it crime? Is it just maybe not a convenient area for stuff? Is there just nothing around there for people? So you want to know that. You want to kind of know what the market sales prices are in that area. Are they asking too much for this particular business? Something that's, one of the first things I look at is crime. What's the crime like there? It's not there's violent crime and then there's like property crime. So I certainly don't want to be in an area where people are getting stabbed, shot, and whatever. It's a little different if maybe there's a little burglary here once in a while. I don't want to be involved in a property where I wouldn't feel comfortable living myself or having my family live. That's just kind of one of the lenses that I use to look at it. Think about schools. If it's a bunch of 1-bedroom places, schools are probably not a big issue because it's probably just one person or maybe a guy and a girl or just a couple. But if you got a lot of 2-bedroom and 3-bedroom units, chances are there's going to be kids there. And so you need to think about schools. You need to think about the saturation of apartments in that area. I live near Richmond, Virginia, and I love Richmond as a market, but the problem is that in the last 4 or 5 years, they have really built a lot of new construction there. And that's competition for what is it's kind of an older city. So most of the apartment buildings that are there, they're at least 30, 40, 50, maybe older years old. And speaking of the age of the property, you need to think about that. I don't really want to look at anything that was before 1980, really. You got to be careful with the 70s stuff with the aluminum wiring and then some of the plumbing. is a problem. There's some insurance companies that won't insure certain properties if they have the aluminum wiring or this other type of polypropylene. I can't remember what the name, but it's a certain type of piping that's in the houses. And then 100% the condition of the property. What kind of shape is it in? How do you figure that out if the property's in Ohio and you're in Virginia? Well, you can get somebody boots on the ground's the ideal way, or you can also try to get some pictures. You can go to Google Earth, Google Maps, something like that. And then think about the utilities. Who's paying the utilities? How much are the utilities? And then one of the last things I think about also is the previous sale data. When did this property last sell? If you can figure that out. And how much did it sell for? So you can kind of look at a trend of, well, they bought it for $5 million 2 years ago, and they're asking $10 million now. Something doesn't add up there. So that kind of helps with stuff. A big one to me is the landlord-tenant laws. Some places are real friendly to tenants, and some are a little bit more favorable towards landlords. You have to be careful to not get into a situation where the laws are such that, you know what, you can't evict them because of A, B, C, or D. It's too cold, or it takes 9 months to get them out. Well, that's 9 months you're not making money. So I think about the landlord-tenant laws, as do a lot of the people that I work with, a lot of my partners and stuff.
That was a fantastic layout and delivery in terms of what are some of the things you look for, right? What are some of the key drivers and things of that nature? So, hey, let's dive into it just a little bit more, right? So, look, you've done LP investments. You're active, you're passive investor. So, when you're looking at analysis from someone else's underwriting, right? You've done a few LP deals. I have as well.
Yeah.
What are some of the watch outs that someone who may not be a savvy underwriter, they want to get into real estate, they want to get into something passively, but they want to know, man, what should I be looking for when I'm looking at this OM or presentation? What's some recommendations you can mention to the user base of some things they really should be paying attention to?
Well, first thing I look at is what are the returns they're projecting. I like to see at least 18% IRR. I like to see at least that 8% cash on cash. And I like to see at least over 5 years, at least a 2x equity multiple, which means in 5 years, you double your money. So that's, not every one of those is set in stone. It doesn't have to be all three, because there are some properties that maybe some areas like where I live in Northern Virginia near DC, things don't tend to cash flow very well because you pay so much for them, but they go up in equity a lot. So that's a long play. You buy it for 8 years, and when you sell it in 8 years, you make a bunch of money. But during that 8 years, you don't make much. And then there's other places that, well, it's not going to go up much in value, but I'm going to make a bunch of money every month. So I think about those things. So it doesn't necessarily have to be all three of those, but I want to at least look at that equity multiple because that incorporates all of that. I want to be able to at least double my money in 5 years. So that's the first thing I look at. Second thing I do is any deal I get into, I underwrite it again myself. I try to get as much of that data as possible. I may not go as deep as they did, but I'm certainly going to spend probably an hour or so underwriting. I have like 3 or 4 different levels of underwriting that I do. I'll look at a deal in a minute and just do a quick, fast, like a 1% analysis. I'll do like a 5-minute underwriting that just takes the core basic stuff and applies a flat expense ratio across things, because we know things should be between 40 to 50. So I put 45% on my expense ratio. I know about what interest rates are going for. You put in the cap rate, you put in the sales price, you put in what the rents are, what the rents could be, and you can figure out a deal pretty quick. You can do that in about 5 minutes. And the next thing I would jump to would be like doing like a 1 hour where I really dig into a T12 and a rent roll. And if it still makes sense, it's 2+ hours digging on it. So as I'm analyzing these deals, these are all the things I'm thinking about. I want to look at what the expense ratio is that they're saying they're going to have. As I said, it should probably, a properly run property should probably run around 45% on expenses compared to income. that's not set in stone because there's some places are more expensive, some places are less.
Yep.
But as a general rule, that'll work for you. The other thing I want to look at real hard is what do they think the rents are going to go to? You can certainly look at the rent roll and say, well, here's where they're at, and then do some analysis with some different websites like Rentometer or apartments.com. You can even go into Zillow and realtor.com and some others and just run some scenarios with, well, what are rents running in these areas? What are people asking? What people are asking, what people are getting. You also have to understand that's going to be two different things.
Thanks.
They'll advertise a place at $1,200 a month, but you look at their rent roll and they're averaging about $1,100 a month.
Matters.
So you have to think about that because rent is negotiable. So you need to build that into your underwriting. Be conservative. I'm very conservative in my underwriting. Not extremely so, but I would rather guess low and end up high than to guess high and end up low, because then your investors tend to not like you as much.
Indeed.
I'd rather surprise them with some extra cash than have to go, well, here's what happened.
Yeah.
So I'm looking at the rents that they want to get. I'm looking at the expenses. I'm looking at what their business plan is. What are they planning to do to try to justify getting that additional rent that they're putting in? What kind of value add are they doing? Are they just throwing some new paint on the wall and maybe some flooring? Are they doing countertops? Are they building in some additional amenities? These are all things that you want to look at and think about. What do they cost to do that? And will you get enough of a return on those over the life of the deal that it's actually worth doing that? When we looked at this RV park, we had looked at bringing some cabins in. But the initial cost to put them in is more than you would get out of them over the 5-year or so life of the deal.
Yep.
That it just doesn't make sense for your investors. Yeah, it makes sense for whoever's going to own it down the road, but it doesn't make sense now. So sometimes you got to back off on your deal a little bit. You don't want to over improve, either because it doesn't monetarily make sense. You can't earn that money back in a couple of years, or it's not what the people in that area would want or expect. And a great example of that is our Taku, Alaska deal. Alaskans are tough, rugged people. They want somewhere warm, somewhere dry, that they can go and stay. They don't want fancy countertops. They don't want fancy this or fancy that. This particular little audience that we have, our tenant base that's there, they're more utilitarian.
Yeah.
They want something that's functional, warm, and dry. So putting a whole bunch of money into fancy quartz countertops and stainless steel appliances, it's a waste of money. It's not going to benefit you. Do work harder on maybe sealing the place up so that it's not as drafty and get the heat a little bit better. And give them a good, nice, clean place to live that's got some amenities outside that they can use. Add a little dog park and some bike racks because there's a ton of kids out there. And then another thing I guess I would look at with the deal, as I talked about, is the business plan. How is it that they want to split the deal up? Is it a syndication or is it a joint venture? If it's a syndication, where do the splits lie at? Is there a preferred on it, a pref? Some people call it a coupon. Is it 7%, 8%? Is it then 30-70 after that, or 50-50, or does it rainbow or waterfall down to something else at a later point in time? So those are all the little pieces I'm going to look at when I'm looking at an LP deal, and even when I'm underwriting something that would be for a GP. Those are levers that you can pull, that you can increase or decrease returns. You got to think about all these things, and that's why I say underwriting. It's math and it's basic core, but understanding the levers that you can pull with whether you're doing, an 8% or 7% pref, or you're doing 70-30 up to a certain point and then 50-50, or you're incorporating maybe some seller holdback or seller financing in the deal. When do you refinance the deal? Does it make monetarily better sense to do it at year 2 or year 3? Maybe if you do it at year 3, you can refinance it high enough to give all the investors their money back, and they can then invest it in something else and retain equity for another 2 or 3 years. That's a big point for them, because then their money can make money for them twice. So these are all the little levers and stuff that I think about and look at whether I'm underwriting for myself or evaluating a deal that I want to get into. What is the most effective way to bring the most benefit to everybody involved?
Okay. Man, that's a fantastic way in terms of some of the things that you look at. A lot of different intricacies, right? A lot of things to think about. And as you progress in time, right, they change, right? Different dynamics. You mentioned Alaska,
Absolutely.
which is a different dynamic versus this Illinois opportunity that you're in. So knowing that and kind of understand the intricacies and kind of knowing what to expect. And again, right, I mean, it comes over time, right? So, you know, as you even get into these deals, right, you're learning new things about, the operations, the intricacies, the clientele for the tenant base that you're working with and things of that nature as well. So, great. Is
one last thing that I always try to do with my deals when I'm underwriting them, I like to stress test them. I like to run different scenarios with rent, expenses, financing, see what that does. Okay, well, here's what I think it'll do, but what if the interest rate, surprise, surprise, what if the interest rate goes up like 4% in the next 2 years? What do you do? What does it look like? Is it still a good deal? What if, the rents aren't going to go up like I thought they would? What does that look like with the deal? What if your CapEx is a little bit different? You need to think about that. Look at the lowest performance in NOI in the property's history and look at the highest, and you can kind of look at that. And can your deal withstand worst case scenarios? Biggest thing, remember, always stay conservative in your underwriting. Don't overguess. A lot of the deals that you'll get advertised to you, the offering memorandums will be really just full of roses and sugar, and it's like, hey, this is the greatest deal ever, and it's like, okay, well, this just doesn't make sense, and I don't believe any of it anyways. Don't assume things are the way they're presented. Dig into it. Do your due diligence, not just after the underwriting, but when you're doing your underwriting, do your due diligence. Dig into these little things. Don't assume things won't change.
Gotcha. Yeah. The little details matters, believe it or not. The little details really, really do matter, right? I mean, it could, in some cases, depending on the severity of it, it could make or break a deal in terms of the return.
100%. 100%.
So, the finite details matter. Wow, good stuff, Tom. Hey, let's talk about partnerships, growth, right? Your growth trajectory, right? You're getting to cruising altitude now, man. You're in a lot of different asset classes.
We're working on it.
Things of that nature, man. So, we say get diversified. What does that mean to Tom?
Well, it's really not putting all your eggs in one basket. We're invested in multifamily. We're invested in, we've got 642 doors of multifamily that we're invested in 3 different states, 1,171 self-storage units in 3 different states, 2 RV parks in 2 different states, shopping center that's here in Manassas. We've done some land flips. So it's really about not putting everything you have in one little basket, because you never know what could happen with any one of those little markets. Just like you wouldn't put, if you're a big stock market person, you probably wouldn't put all your money on one stock. You'd want to put it on a couple different things, and you might even vary them across energy and medical and computers and other stuff like that. So you want to certainly diversify. Our next kind of thing is really building the partnerships that we already have, developing some new ones. Partnerships are critical to having successful deals, not just finding them, but operating them. Because when you get into a deal with somebody, you're getting in bed with them for a period of time, 2 years, 5 years, 7 years, whatever. So you really need to know, like, and trust the people that you're getting into these deals with. It's a terrible thing 6 months in to find out that your partner's really not what you thought he was, and he's not bringing to the table what you need him to bring to the table, because it can hamper your ability to make the deal successful. So it's important to spend some time, get to know people, talk to them. You don't have to jump into bed with them right away. I mean, there's people that I've known for that I got into this RV deal with that I've known for probably a little over a year. Hadn't really thought about doing deals with them, but I felt comfortable enough with them from having known them that when the opportunity came around, I'm like, yeah, I trust this guy. I don't have to sit there and go, well, that's a great deal, but I don't know about Joe. I need to go figure out Joe. Build those relationships ahead of time. It's sure, it's what you know, but more importantly, it's who you know and who you're putting yourself around, and the kind of deals that they're doing and the kind of people that they are. I want good, credible people that have good ethics. I'm not looking to go out there and be Slim Shady.
Yeah.
Okay. I'm not the real Slim Shady. I want to provide good quality housing for my tenants. I don't want to be that landlord I'm just here to make the money and, the hell with you. Your roof can leak for a little while. It's okay if your dishwasher doesn't work. Just use the sink. I don't want to be that guy. So I also don't want to be with partners who want to be like that. You don't have to be extravagant, but at least be a decent person, and somebody that's credible that you would trust to be in a deal with for a period of time, because you will.
Got you. You come back to the notion, right? Know, like, trust, right? It may take a while, right? To get and understand your partners, but the more you know, the more you grow, the more you're along that same trajectory. Everyone wins at the end of the day. Man, Tom, this is fantastic, man. Man, look, how can folks reach you? How can folks find you? Would you share for the viewers where folks can reach you, man?
Well, you can reach us at our website, Alliance Acquisitions. It's allianceacq.com, or email us at info@allianceacq.com. You can reach out to me on Facebook, Tom Rivenbark. I'm in there. We've got Alliance Acquisitions Facebook page. I try to post as much as possible on social media. I'm not as good as I should be, and my wife tells me I need to do more. So she says it, so she's the boss. I must do it.
Continuous improvement, man. It's all good.
That's probably the easiest way to get a hold of me.
Sounds good. Well, Tom, hey, man, it's been real. Hey, we appreciate you sharing those insights and those tips on underwriting. What are some things you look for when you deal and working with partners, and some of the watch outs along the way as you're in many, many different asset classes, man. So, man, on behalf of myself, my boss, Jacqueline, and man, we appreciate you, man. Thanks for your time, Mr. Rivenbark.
Hey, man, it's been fun. Thank you for having me.
Appreciate you.
Jacqueline and Melvin, thank you so much for taking time out of your busy day to listen to this episode of Get Diversified. Please make sure to subscribe to our podcast so you don't miss out on future episodes. Finally, stop by our website and follow us on social media. Ciao for now. Make it a great day, and we'll see you next time. And remember, get diversified.